Hey, welcome to NAAIM Confidential episode 10. I'm this week's host, Ryan Redfern. Today we have Jim Lee. He's a CMT, a CFA, a CFP, financial futurist at StratFi, and the author of Foresight Investing. When we were preparing for this podcast, Jim had a great phrase that said, "Why has market timing got even easier over the past 10 years while stock picking is now more difficult?" I thought that was a great premise, and we're going to get into that in a little bit, but I wanted to start with the NAAIM Exposure Index. You can see that here. I don't know if you can see my mouse or not, but 104.75 is the highest number we've had in quite some time. I thought it was so interesting because it was noted by Elliott Wave International, noted that that's a very high number, and that frequently corresponds with high market peaks. So I thought that was just something interesting to talk about, or just to notice, since that was in the news this week. I know Jim is not a contributor to that, so we'll just move on to futurists. If you want to, I'll make you the presenter, and if you want to tell us a little about your background and what you do and how you think, and we'll go from there.
Sure. Yeah. Wonderful. Thank you very much, Ryan. Always a blast talking to you.
Absolutely.
And as you mentioned, I am a financial futurist, and StratFi's a boutique investment advisory firm focused on what happens next. Okay. And I'm always trying to look at big trends. I'm always trying to look at the markets and how to position my clients accordingly so that their portfolios can benefit from that.
Yep.
And I started about 12 years ago. Okay. So I'm trained as a chartered financial analyst, which I always tell people, being a CFA tells you how not to lose money. Mm-hmm. And being a CMT tells you how to actually make it for people.
Nice.
Okay?
Can appreciate
that. Yeah, of course. So what I found is starting about 10 years ago, I started building model portfolios, and I'm trained in fundamental analysis and in stock picking. A lot of people do it. And those portfolios were lagging for a while. Okay. And sort of the paradox here is that market timing is something that isn't even theoretically possible. Okay. Like, there's no way that this should work. And I've been doing it for the better part of 10 years successfully. Yet stock picking is something that should work on occasion, but it's gotten harder and harder to do over the last few years. And NAAIM is a group made out of, it's the National Association of Active Investment Managers. We're stock pickers, we're market timers, we do it all. And I'm beginning to find that market timing is becoming something that adds a lot more value lately than stock picking. And the question is, how does that work? Why is that happening?
Right.
So I'm going to go into show and tell mode here. Right.
Love it. Yeah.
And hopefully you can see my screen now.
I can see it.
Yeah,
maybe
great.
There's a season for everything, right? Seasonality.
I guess so. Right. Yeah. Seasonality for technology working. So,
absolutely.
So I've been doing market forecasting for a while now, and the truth is, it's kind of an inexact science, right? It's kind of like making spaghetti sauce, and these are the ingredients to my sauce for anticipating the market's movements. And what I start out with, it's a statistical model. Mm-hmm. I start out with the daily historical probability of gains each and every month of the year, each and every day of the year, going back, 20 years plus worth of data. Then I make adjustments for calendrical effects like weekends, holidays, options, expiration dates, etc. Then I add into the mix, some spice, right? Some of these short, mid, and long-term cycles. And I then take a sampling of the days to create a daily score, right? So I combine those factors together to create a daily score. And then in that daily score, I pick the days with scores in the top 40th percentile. Okay. And in those days, I'm going to be invested in index funds. For particularly aggressive clients, I will use leveraged index funds. I call that caffeinated versus decaffeinated. Okay.
Love it.
And the caffeinated, it's for people who like growth and excitement, and that uses leverage. And then decaffeinated is for people who are nervous, they get the jitters, and they want to sleep at night. Okay.
Right.
So those use the unleveraged index funds. So I'm invested in the market 40% of the time. I'm in cash 60% of the time. Okay. So most of the time I'm just hanging out in money market funds. So each December, I build a trading calendar for the upcoming year. So I know all of my trades in advance. I can actually plan my vacations around my trades, which never happens in this industry, as you know.
Right.
And then I give that calendar to my trading desk, and then I walk away for the next 12 months, right? And I let them do all the trades, and they do great, okay? And that's sort of the basic methodology that I've been using, in its current iteration.
Sure.
And this is my actual trading calendar from last year. So this is the 2023 edition of the, StratFi trading calendar. And the days that are in yellow are days that I'm invested in index funds. Days in white are the days that I'm in cash. S&S stands for Saturday and Sunday. H stands for all of the market holidays. Okay.
Mm-hmm.
And you'll see that my trading algorithms have a bias towards being invested in the market in the beginning of the month, in the middle of the month, and the end of the month. Okay. Statistically, the odds are a little bit better on those days. And I had a whole bunch of other statistical factors as well.
Sure.
And I think I only skipped one day when there was like that mini financial crisis, like spring of last year. I called an audible and say, let's just stay in cash an extra day. But generally speaking, I follow this very closely. And if you look at this calendar, you'll see that I had a lot of exposure last year. I was all in the market throughout the year last year.
Mm-hmm.
And you might wonder, why is that case? Why was Jim so bullish? It actually ties to one of the major cycles that I've been following. So I use some software from a group called the Foundation for the Study of Cycles.
Mm-hmm.
And they can do something called a spectral analysis of the stock markets, where they look at all the cycles with lengths of anywhere between, in this case, three weeks to 400 weeks, on the long side. And they can tell you which cycles have the best fit and which cycles are the strongest. And there's one cycle that just went way up to the top of the ranks. And this is the 182-week cycle. Okay. And this thing has been amazing, right? This is the single most relevant trading cycle in the market over the course of the past 20 years. And you can see that this thing peaked out right at the end of 2021. Okay. It just said, just stay out of the market. I wish I knew about it then. Okay. I actually discovered this cycle kind of closer to the bottom, like June of 2022, thereabouts, is when I started learning about this stuff. And what it said at the time was that, hey, the beginning of 2023, you need to go all in, right? Mm-hmm. Because it's looking really good. And then I last ran this right here in December of last year. And it said, we're not done yet. Mm-hmm. There is still a lot of upside here in this market until spring of 2025. Okay. Now, this is only one factor. It's only one cycle. There's a lot of other cycles, but this seems to be the big one. And I was trying to look at this thing, and I started wondering, hey, it works in practice, but it works in theory, right? So why does this thing have any relevance at all, right? And I even looked at like the presidential election cycle, which exists, mm-hmm. but it's not as strong as this one. And I found out that this 182-week cycle has a name, and it's called the kitchen cycle, as in like the kitchen sink, right?
Okay.
And it was originally discovered in the 1920s by an economist named Joseph Kitchen. And lo and behold, this is the business inventory cycle. And it's been around for 100 years. Like this isn't new news mm-hmm. at all, right? I also ran an updated version of the cycle, and I tested it on the Dow Jones Industrial Average going from 2015 to this week. So over the course of the last 110 years, this cycle is still the top performing long cycle of the market and has been for a long, long time, which is just completely fascinating to me. And to the point of the NAAIM forecasting panel, it is pretty bullish and continues to be so. There are going to be some ups and downs. The market never moves in a straight line, but it's pretty optimistic for a while. Okay, and this is just one ingredient in the sauce, so to speak. So this is really, really good stuff. Okay. Now on the stock side, I manage individual stock portfolios too. And it's been harder, like you can do it. I definitely did it last year, and this year is off to a good start too.
Mhm.
But I've been finding that stock picking as a manager has been getting harder over the last few years. And there's really a lot of attention going on right now to the Magnificent Seven and the mega cap stocks that we all know and love. Amazons, Teslas, Googles, and Alphabets of the world. And this is a comparative chart that looks at the biggest of the big cap stocks, right? This is the NASDAQ 100 index, which in some ways is a very concentrated form of the S&P 500 index.
Right.
And this looks at trailing performance going back to 2010, right up to this week. And that's in the blue line. So this is the performance of the NASDAQ 100. The green line is the performance of the S&P Small Cap Index. Okay.
Mm-hmm.
And if you look at this thing, it's been going flat. It's been going sideways for 3 years. It has effectively done almost nothing. Okay.
Right.
Well, the NASDAQ is hitting new highs, right?
Mm-hmm.
If you look at the cumulative difference in performance, and you really got to, get in close to the screen here, there is a 1,000 percentage point difference in performance over the last 15 years. 1,650% return for the NASDAQ 100 versus a mere 667% return for the small caps, but that is huge. I mean, that is such a big gap.
Yeah.
And then this bottom black line here is a comparative relative strength chart. So what we do is we take the value of the green line on a day-to-day basis. We divide that by the value of the blue line on a day-to-day basis. Mm-hmm. And it tells you on a relative basis which one's doing better, okay? And you can see it's been going straight down for a long, long time. Okay, we had a little bit of a reprieve, and looks like 2020 and towards the end of last year, but it's been nothing but down for the small and mid cap stocks in terms of relative performance for the better part of a decade, which is a very, very extended dry spell for most active managers who are trying to add value, ironically, by doing smaller stocks, which theoretically should do better than larger company stocks that have already had their growth spurt. So, that's another one of those little paradoxes that I was talking about. And, I was thinking about that. I was thinking, maybe the structure of the market has changed over the course of the last decade. And I get a lot of research from Morningstar. So this is a Morningstar graph. And I did a ranking of mutual funds ranked by assets under management. So these are the top 10 mutual funds right now. And you'll see some real interesting things from this chart. First of all, out of the top 10 mutual funds based on assets, 9 of them are passively managed funds, okay? There is no one at the steering wheel of these things. They're all algorithmically run, right? They're an index fund or it's a tracking fund or whatever. They are managed by a total of what? 3 companies. Okay. Vanguard has been hoovering up assets for decades now.
Yeah.
You've got one Fidelity fund. It's not even the Fidelity Magellan fund. Peter Lynch would be rolling over in his grave, right?
Right.
You have one actively managed fund, and that's not run by either Vanguard or Fidelity. It's run by American Funds. It's their flagship. And that is it for active management in the top 10. That's the whole thing. And then you have like this bond fund down here, and you have an international fund as well. But, you've got 4 S&P 500 tracking funds in the top positions. 3 of them by the same company. Okay. So the idea here is that if everyone is doing everything at the same time, okay, you can use that information to your advantage potentially. Okay. And I think what's been making my market timing situation work is because I'm not predicting the markets per se, but I'm predicting the flow of money going into the markets, which usually happens once or twice a month in the beginning of the month and probably in the beginning of the month. Okay. That money goes into 401k and retirement plans via, payroll withdrawal. It tends to go into index funds, and it tends to go into the S&P 500 every single month, right? And if you have that kind of sugar hit going into the market,
right,
at the same time every month, something's going to happen.
Yeah.
So I think that's one effect that's in play. And then the other effect is that if everyone's buying all of the same stocks, which are weighted in these funds based upon their market capitalization, you're going to have a drift such that the larger companies and the larger funds are going to get most of the money on a month in, month out basis. And I'm a little challenged as a manager because I'm finding a lot of smaller companies that are getting better growth at better valuations, but nobody cares. Okay. Nobody cares. Doesn't matter, right? They don't get the momentum. At some point, this is going to change, but this has been going on for a long time. And it could go on for a while longer. But it is fascinating that while passive investing, now pretty much owns the market, I think that it does open up opportunities for market timing, which maybe did not exist before.
Oh, for sure. And I was thinking that you're just showing the S&P and the large cap things, but inside of target date funds, for example, that money is all going to these same places as well. It's not getting into any active things there as well. So there's so many funnels that bring it into this same place.
There's more than this, right? If you look at robo-advisors, okay, and everybody has a robo-advisor now, Schwab, Fidelity, Vanguard, all that. They advertise, we will put you into diversified portfolios using Nobel Prize award-winning technologies from 1950. Okay.
Exactly.
And then you look at these things, and they're pretty much all performing within a percentage point of each other based upon risk tolerance because they're all doing the same thing.
Right.
Which kind of takes the fun out of it. And it's just fascinating to watch.
For sure. But your process really goes to more of a calendar seasonality style of investing. I mean, there's not really watching the markets or even caring day to day what's really happening. That is a fascinating thing.
I tried caring, Ryan, I got my degree in economics, and I was building all of these econometric dashboards. Market technician, looked at all of the moving averages and point and figure charts, and I've done all of that, and nothing works so well as just a purely statistical approach that enables me to schedule my trading around my vacations.
But that is something I've not seen anyone else doing. I mean, I talk to a lot of managers being involved with NAIM. I mean, nobody does that. I'm starting to think more that way because of you. So I always enjoy these conversations to hear how you think.
Yeah, well, I mean, it works for me. Really, I mean, it's been nice. We can't talk performance, unfortunately, because there are
Of
certain
course.
regulatory constraints that we're all familiar with that prohibits public discussions of performance.
Right.
But from a methodological perspective, it's really clean. It works well for retirement accounts from a tax perspective. It's a little
Mm.
bit that way. And I use this more as a satellite to core positions.
Okay.
So when I build portfolios, it's not all going to be in market timing,
Mhm.
but it's going to be like a 15% portfolio allocation where I'm going
Okay.
to have more buy and hold in the core. And then around the edges, I'm going to be in and out of the market to manage exposure.
Sure. But from a traditional standpoint, that can take somebody from moderate aggressive to moderate very quickly. That's how I
Yeah.
always think about it. If you have like maybe a 20% sliver of that of active, that can take them up and down a risk level at a fairly quick pace. Um,
Yeah, it's sort of dynamic risk management. And it's true because as a manager, just changing the allocation of all of your clients' portfolios all at once when they're all calling you at the same time is hard,
right. Oh,
right?
yeah, absolutely.
Right. You know, when everyone wants to talk with you right now, you need to have a plan so that you can get out before the calls come in. And the expression that I like to use is the trend is a trend until it ends or it bends.
Right.
And cycles tell you when trends bend and when they end.
Hmm.
So they're super useful.
No, absolutely. Back on your slide that showed the calendar of the year, you mentioned that there are
Mhm.
two funds that you invest in. One's the S&P. What's the other one there?
Yeah. Are we going back here?
Yeah, yeah, if you don't mind. Yeah, I can see
Okay,
it.
cool. Cool. Yeah. So I use the RightX funds.
Okay.
Um, this is not an endorsement or, a
Yeah.
recommendation, but RYTNX is an S&P 500 2X index.
Oh, that's the 2X. Okay. Okay. So
That's the
just S&P.
2X. And it's just the S&P, and it's a fund specifically built for active traders.
Right.
So every one of my clients in the strategy, they
Mhm.
get the same execution because there's
Right.
no bid-ask spread, there's no commission, and there's no slippage, right?
Right.
Um, so it's just super, super clean. And yeah, no commission.
Yep.
And then the other one's just a standard S&P 500 fund,
Yep.
which is how I do that. And
Exactly.
you can do it with other index funds, but sometimes they want you to have a fixed holding period.
Right.
Other times, index funds will have a commission if you're in and out, more than once or twice a week. So
Yep.
this is specifically built for active traders, and it works better even than ETFs, in my
Oh, for
opinion.
sure. And I think a lot of retail traders don't understand that Vanguard does not like you buying and selling their funds. They will cut
No.
you off very quickly if you do it like twice in 30 days.
They
Yeah.
will, yeah. So there's kind of a limited universe. I mean, Guggenheim and Ridex,
Right.
you know,
Pro
both
funds, pro
both do
funds
that,
also.
and Pro Funds, of course. Yeah, Pro Funds also has sort of a suite of specialized mutual funds specifically for this purpose.
Right. Right. No, that's a neat angle to be at. Well, cool. I think we're getting close to the end there. Do you have a favorite investment quote to share with us?
Yeah. Well, this one's mine. Okay, so
I love it. See, even better. Is it out of your book?
yeah, probably in the book somewhere. But yeah, it's the idea is that if you want to be in the right place at the right time, you want to show up a few minutes early, right?
Love it.
So, it can just look like you're being lucky, but you kind of plan to be there and you just show up a little bit early. And that's really what I try to do with this market.
Love it. Love it. And of course, I was going to say, how do we get a hold of you if we want to find you? I think you've got your page here. You got your
Yeah, right
email.
here. Right here. Yeah, jlee at stratfi.com.
Perfect.
At JHLINDE for Twitter. And then you can just look up our website at stratfi.com.
Perfect. Are you on Twitter frequently?
So I use Twitter as kind of an archive of interesting scanning hits or trends that I want to
Okay.
remember. Okay, so I'm
Interesting.
not active, but it's a filing cabinet of things that futurists find interesting.
So if I were to go to your Twitter, I would see your archive?
Yeah, you
Or
would
do you
see
post
my
it?
archive. Like I think I had one quote in there about some research that was done in China to create nuclear powered batteries the size of a watch battery, right?
Whoa.
Which means that,
Yeah.
if this got adopted, you'd never have to recharge your cell phone. But then you think about having like a nuclear battery in your pocket, and you're like, what could possibly go wrong?
Right.
So like this could go either way. But it's just stuff like that that's a little bit fringy and off the radar screen that aren't quite in the public awareness yet. That's what I put in my Twitter
Right, right. And you covered a lot of that stuff in your book as well. It's very like up and coming technologies and thinking
feed.
and
Yeah, the first 100 pages is all about trends. And I actually give buy lists, like if you want to participate in these trends, you can look at the chapters. At the end of the chapter, I have all of the companies that are active in those trends. Or you can look up the ETF. Sometimes you can use ETFs as shopping lists
yeah,
to see what they're doing and use
absolutely.
that as a starting point for your research.
Absolutely. Well, awesome. I think we're about at time, even though we started a little bit late. Thanks for hopefully everyone hung on until the end there. Jim, great to have you on. Good to see
Yeah.
you. We'll see you again soon. And thanks everybody for being here at NAAIM Confidential. We'll see you next week. Thanks, Jim.